Okay, so yesterday we discussed about the financial statements fraud is just an overview, and we did a little bit on the different techniques used for financial statement to detect financial statement fraud. In fact, one of the things that I did not talk about it yesterday is the Altman Z-score and the M-score. Altman Z-score is usually used to predict bankruptcy, and M-score is much more accurate when it comes to financial statement fraud. And both I ran for one of the companies that was at risk. And after I got the result and I shared it with the management, 3 months later, basically the company declared bankruptcy. Okay, they had a financial statement issue. So the scores in itself, we should not take it as granted, but it's a good indicator of that inherent problem, because they use a blended method of blended ratio. It's difficult to fudge those ratio. Okay, today's discussion will be about revenue and inventory related fraud, financial statement fraud. So basically we'll talk about the revenue, how it's impacting, how it is easy to manipulate, and the ways to look for revenue related financial statement fraud, and understand the importance of and the way to follow up on revenue related fraud symptoms, discuss inventory related financial statement fraud schemes, identify the ways to search for inventory related financial statement fraud symptoms, and they explain the importance of and the ways to follow up on inventory related fraud symptoms. So the most common one, in fact, I saw a statistics of it couple of years back, and also ACFE, they are in the report to the nation, they also highlighted about 56% of all fraud committed, financial statement fraud that has been committed relates to revenue manipulation. Okay, and the COSO, they did a very comprehensive survey, and that also came out with the same conclusion, that the revenue is the #1 line item in the financial statement that usually are manipulated in case wherever we found financial statement fraud. The revenue is the reason one they like to have revenue, because it is easy to manipulate. There are many alternatives to manipulate the revenue based on the industry. Sometimes the same industry, you have multiple ways to calculate revenue. For construction industries, you have the percentage of completion method. In consignment industry, there is one way of doing it. You have retail industry, they have another way of doing it. There's so many variation and there are so many options that's available to calculate and recognize revenue, that you can do a change in a little bit in the parameter and you can manipulate the number. For example, for construction completion method, the percentage of completion method, you can change the percentage of completion. It's an estimate, and suddenly your revenue looks better. So, or manipulating the period, you can do that. Or sometime you can manipulate the provision area. Okay, you recognize the provision as revenue. Sometimes you use a topside entry, just one entry that reduces your provision allocation and credits it to the revenue. So this type of topside entry is also another way to manipulate the revenue. The receivable, you increase the receivable, suddenly revenue looks good. Many people don't pay attention whether the receivables are converting to cash or not. So there is a days in receivable. That's usually a good measure how fast the receivables are getting converted into cash, and also that the industry standard. Each industry, there are certain benchmark, like how soon the revenue should be converting to cash. That is days in receivable number. And if you take that industry number, and if your company is doing way above the industry average, that should be a warning sign, or at least needs to be looked at to make sure that that's making sense It's the really that's exactly happening. And of course, also you need to look into the cash. Okay. So one of the guy, the ZZ Best, he was the mastermind of ZZ Best fraud. He basically stated that, receivables are a wonderful thing. You create receivables and you have revenue. As simple as like a magic. And most of the organization that you will come across, you will see that one item they will never let go is manipulating the revenue.
Yes. Sharif, sorry,
yes.
can I ask one question on the revenue?
Yeah, sure.
It's very interesting because, as we know, we have a lot of accounting practice like, FASB, in the past it's 104 or SC 606. And it's actually a lot of things, determine how the company should rev rec. But I'm curious, even with that regulation or accounting practice, people still can very easily manipulate the revenue recognition?
Yes, yeah. See, a lot of the time in every company, sometimes you have, especially when you have diversified company, they have multiple ways to do the revenue calculation. Okay. FASB gives you, or IFRS gives you guidance how to recognize revenue. That is true. But what they will do, there are a lot of estimates involved in the revenue recognition also. What they will do, they will change the estimate. Okay. And if the auditors, if they are not paying attention, they will miss those minor changes in the estimate. Okay. Even when you change your estimate, you also need to justify it in the disclosure in the financial statement. Okay. And in the cases that we have seen, like in the WorldCom case, in the waste management, in Enron, in Tyco, the WorldCom was a classic example. They did not take any complicated measure. They did a very simple thing. I mean, I worked on the WorldCom, on the revenues section. We had 30 professionals working on the revenue section, okay, to identify the revenue fraud. And I worked on they have a provision area. I worked on that section alone. And I was able to identify $110 million worth of fraudulent entries. What they were doing, see, in America, for telecom company, they are charged a 2% levy by the government, FCC, that is usually used for supporting telecom service in the underprivileged areas. So this money is sitting in the provision. Okay, what these guys are doing, they did a very nice calculation. Column one, actual performance. Column two, what the market was expecting from the management. And their third column was the difference. So now this is the gap. Now with this gap, what they were doing, they're putting an end, they're finding out where can we get some extra fund to bridge this gap. They found one of the area was this revenue sitting in the provision. So they are debiting provision and crediting revenue. So it's like a magic. Suddenly your provision is less and your revenue is more. And the auditors, they did not pay attention to these type of adjusting entries or topside entries. This is something to do with the auditor. Like, when I was doing audit, one thing I was looking into was also too many adjusting entries. When you see too many adjusting entries, you should take that should be a red flag. Why those adjusting entries are coming at the last minute? Okay. Another thing I did, this was another technology company based in Delaware. And we were attached with the audit team. The forensic was attached to the audit team to look into the company, whether the auditors are capturing the risk properly or not. So I spent about a day going to the, I spent about a day with the audit team. And then I asked them, okay, where are you selecting the samples from? See, auditor, they cannot possibly transact test all the transactions, right? So where are you getting your transaction samples from? Then they took me to a room, very nice room, all organized with binders, with the labels, with the items, and they basically said, this is the room where all the samples are, all the transactions are kept. We go and take the samples from there and do our sampling testing. For me, for a multinational company with so much transaction, to see that all the transactions were captured in one room, to me, it didn't make any sense. So I asked them that, what do you think, how many transactions are automated transactions or how many are manual transactions? They're like, oh, maybe 10% manual, 90% automated. That's great. And when our data analysis came through, we noticed that, in fact, it was the other way. Almost 80% of their transactions were manual transactions. So there's no way they could have selected their sample from the right population. So that company was high risk of getting, because basically they were fooling the auditor, and auditor did not really want to face the music because they have a budget shortage and everything they need to meet. So this is how things can happen, and the auditor will miss it. Okay, and the regulation is there. They will meet the regulation by book, but this is fraud. This is not done by mistake. There is a deliberate effort from the management to deceive the auditor, and sometimes the auditors are missing it, as auditors are complacent also. Okay, in case of WorldCom, the internal audit team, they were tasked to support the management. Okay, they were given task in a way that they have to add value to the operation. Otherwise, they are going to be, they were kept busy in activities that relates to operation. They were not really doing internal audit. So in many companies, you will see that there is an audit department, either it's understaffed or doesn't have the right kind of qualification, or they give them this new concept called add value to the company. So the audit is more busy supporting the management than trying to be independent and look for issues that can compromise the financial statement. So this is my experience. Okay, it's nothing to do with the regulation, it's the intention. So when we are talking about fraud, there is an intent to deceive the user of financial statement. Sometimes they are forcing the employee to book wrong entry. As I told you, my friend, he was working for, at that time, I think, waste management. And he was telling me that, Sharif, I am putting entries, these are fake entries. And I can't even say no because the CFO is sitting on my back. He's standing on my back, making sure that I am putting this entry through. So that's what it is. When we're talking about fraud, we're talking about intent, They know they're doing something wrong, but they will do it. Did it answer your question?
Yes, it is. Thank you.
Welcome. So how many ways we can do the revenue related fraud? As I told you, revenue is a beautiful area. It's easy to stuff, it's easy to manipulate. In one company, I have seen what they did. The CFO was pressuring the controller to book the entries. Now, when you create an entry that you know is fake, what are you going to do? What she created a 1300 account, suspense account. She's putting all this almost $30 million worth of transaction in the suspense account. Auditors never really looked into the GL detail to see there is a $30 million sitting in the suspense account. They should have questioned why they have $30 million sitting in the suspense account. And if they asked the question to the controller would have told them the whole story. Okay, since nobody asked, she has no reason to come forward, So these are the kind of issues that we will face, that numbers sometimes are there, but we're missing it. We're not analyzing it properly. Now, the common revenue related frauds, I will discuss some of the techniques. Okay. One is related party transaction. What they will do, like Enron case and WorldCom case and many other cases, well, what they'll do at that time, as I was telling you yesterday, at that time, I think it's still in America. Now they have changed a little bit. That if you have your controlling share is 5% or less than 5%, you don't have to consolidate. So what the Enron was doing and WorldCom was doing, they are doing some entry where their liabilities are assumed by these offshore entities, creating fake receivables. Okay, very simple entry. Basically, they're selling, they're transferring this liability and creating some asset. As showing a receivable, the company will pay us back later on. And since it was less than 5% control, it was not consolidated. So it stays off the book. Okay. So it stayed off the book. And it is not also disclosed in the financial statement. But actually, in reality, the Jeffrey Skilling, the Barney Ebert, they were in, or other management, they were in control of the, they are in control of these entities. Okay. So by doing that, they hid the real transaction. That is another. Remember, you create receivable, your revenue goes up. Sham sales, fake sales. Okay. Fake sale is another one. This, you're not actual sales. You just create a sale and show it that your sale has gone up. Bill and hold. So you bill. Sometime what happened? The customer will tell you to hold the goods on their behalf. But in that case, you have to have the right document to show that the actual liability of related to those assets has been already transferred to the customer. So even if you're holding, if something happens to it, you got your money. There's insurance or something that the customers have bought that's protecting your interest. Only then it works. But in most cases, what they will do, they will not disclose that. They will bill and the asset will be still sitting in the company's warehouse, but they will recognize it as a revenue. But in actuality, if you have the liability under you, then you can recognize it as revenue. That's the usually revenue recognition rule. Side agreement. You have a side agreement like warranty. You have a normal warranty condition. Well, because your warranty is a liability and you have to write off warranty based on the time period. But you have issued a separate agreement to a particular big vendor, giving them a special treatment that they can, this warranty period is much more shorter or much more longer. And it is not, you're not disclosing it to the auditor. They don't know that you have this side agreement. And it creates additional liability for you. Okay. And it is not disclosed anywhere in the financial statement. So this is another way you can create fake revenue. Consignment sales, that's another one. Channel stuffing, that you are basically asking your vendors that they can, so they can put bulk order. Later on, they can return it. So at the end of the year, they will make a huge order and you will ship it to them. But later on, maybe in January, you're going to buy it back. So in reality, you're just showing a huge increase in sale during the year end. Okay. The lapping and kiting, that you're taking one account and paying the other off, and the paying the other off, you keep on doing that. At one point, you lose control over it. Redating, refreshing transaction, that is, you are going to change the date of sale to make it more current, or sometimes you change the date so that you don't have to write it off. Okay, you may be going to, if you use it at the receivable dated at the actual date, you maybe have to write it off because there are rules about how long you can keep the receivables outstanding. So you redate it to make it look like, no, it's not a bad debt yet. Okay, liberal return policy. This is another thing, you know, sometimes, especially public transportation companies, they face this problem that you bought a ticket in advance. In fact, it stays in the record as an outstanding item until you use it. So nowadays, like for example, you have your airlines mileage. Once upon a time, it used to be unlimited. It will never expire. And that creates a problem for the airlines about the liability related to it. Okay. Nowadays, it will tell you that no, it will expire. After 2 years, your certain portion will go will expire. That gives you a little certainty and calculation certainty. Partial shipment scheme. You only ship the part of the order, but you recognize the whole order as income. Improper cutoff. I told you about revenue management yesterday. Something like that. You are basically, you know, this is not the income for this period, but income from the next period, but your January income little short. So you keep the books open couple of days, so to recognize some of this February income into January. Okay, to make it look like your performance is consistent. Also, I told you the revenue management concept is kind of similar. You take revenue from one period and try to take it to another, so that your performance looks more like smooth. You smooth it out. That is also illegal.
Yeah. So Leaf, just one thing. Is the commission the motivation for all this? Because most cases when they do the revenue recognition fraud issue is mean that they mainly target the commission or, you know, high performance bonus.
These are usually done by at the behest of the top management. So their main motivation is stock option, stock price, okay, higher bonus.
Yeah, so it's a bigger scheme.
Yeah, much bigger scheme. Commission is the interest of the small, what is that, you know, the salesperson. How much is going to steal? Couple of $1,000. Okay, but that's not the issue. In the insurance industry, like, you know, insurance industry, the agent, they do manipulate a little bit, but how much they're going to steal? But this we are talking about at a very high level.
Yeah,
revenue, the fraud cannot happen at a material scale without the knowledge of the management. That's my experience. If you look at all the statistics, you will see it is usually at the behest of the top management.
Yeah,
CEO,
and mainly
CFO,
it's a bonus,
CEO.
those things. Yeah, promotion, everything. Okay.
Exactly, they will mandate it, or they will dictate it. Sometimes CEO may not be involved, but he will put a target so unreasonable. Basically, you're telling them, I don't want to hear how you're going to achieve it. And I have seen that happening in one of the organizations I used to work for also.
Yeah.
Okay.
I see in the partial shipment that they actually book a full rev rec before. Yeah.
I've seen that also. Improper cutoff, I've seen that also. Okay.
And even they use the wrong stamp. Like normally you cannot rev rec if you ship to warehouse. You have to ship it to the end user. But once they deliver the product to the warehouse, they rev rec fully.
Yeah. So all kind of things will happen, but you will see that it is done usually because it is done at a much bigger scale. Only a warehouse manager will not be interested in it, because what is his benefit? A warehouse manager, he will benefit from stealing the inventory. He will not benefit by doing this type of functioning. He will only do it to keep his job because his boss told him to do it. So if you trace it, it goes to the top. You know, warehouse manager, the kind of fraud he will do that will benefit him is usually pilferage, misappropriation of asset. Okay, if 10 order comes and he will give the 11th on, or 10 order came, he will deliver 9 and recognize 10. These little bit things he can make money on. But on a bigger scale, that is going to come from the management. That's why another name of financial statement fraud is management fraud. So this is the normal transaction. That's usually how it happens. Okay, you sell goods and services, then you estimate the uncollectible receivables. If the goods are returned, yes, and this is schematic. Now, when it comes to fraud, in every segment of this transaction, you can manipulate and create additional revenue. You can reduce the write-off. Okay, you can reduce the discount taken. You can manipulate the goods return. So each and every cases you can manipulate and increase the revenue. Now, to do revenue related fraud, there are certain 6 type of symptoms that we can look at. So remember one thing, like this type of fraud you will not visualize usually, because these are entries, these are documentations. But there are 6 symptoms that we should pay attention to as an auditor, as if you are doing a compliance or internal audit, then we need to pay attention to these 6 type of symptoms. These symptoms on its own does not tell you anything, but in these symptoms, when you take it in a collection, it indicates a much bigger problem that needs to be looked at. So that way you have to really change your audit methodology and review methodology to make sure that you cover the risks. One is analytical symptoms. So as an auditor, especially those who have worked in the financial audit area, then you know you do analytics at the end of the year. You take last year's balance, you take this year's balance and see if there are any unusual variation. Now, usually in the audit materiality test, you have that variation percentage. So if you see the variation going above that, then you need to look into one second. Then you need to look into the details to make sure that there's nothing unusual happening. Sales discounts appears too low. Sales returns appears too low. So you have an industry trend. Remember I told you, we have an industry trend. You have your company's performance for the last few years. And when you see any unusual spikes, be it high or low, you need to investigate. In fact, as part of the audit analytics, we need to investigate and write our the comments, our opinion, our observation to make sure that there's nothing unusual happening there. Here, bad debt expense appears too low. Account receivables that appears too high or are increasing too fast. Allowance for doubtful accounts appears too low. Too little cash is collected related to reported revenue. Remember that revenue is going up and your cash collection is going down. So cash from operation. So you have cash flow statement. I'm telling you, even if you want to do your personal investment into a company, look into, don't just jump into by looking at the analyst estimate. Look into what is happening to the operating cash flow.
Yes, Sharif, just quick one on the too low figures. Is that like a trending analysis, like based on that? So is that, do we need to benchmark against both internal and external data? For example, you mentioned, okay, look at the market, trend. And then also, we look also internal historical trending within our own company. Okay.
Yes. I'll tell you an interesting story. It's not really about the audit, but it was about a litigation. This company, I forgot where the company was about, where it was located, I think Ohio or somewhere. This company, it went bankrupt. They were in furniture business, okay? And the CEO and the management sued the CFO for not doing his job. And because of that, company went bankrupt. And we were defending the CFO in the lawsuit. There were $26 million involved in the lawsuit. And they were giving a lot of arguments how the CFO has failed to perform and the company went bankrupt and this and that. So one of the things we did was we collected the industry data and the trend and plotted the company's performance on that trend. Okay, and we realized the industry was really suffering at that time. And the company was consistent, performance was consistent with the industry trend. And that was our argument to, when we presented to the lawyer, that the CFO has nothing to do with the industry was at risk at that time. Okay, so this type of analysis is very, very useful for many purposes. For financial statement also, for financial performance also, if your company is going against the market, there better be a very good reason. What are you doing so good that every industry is suffering and you are doing excellent? Like for example, now in the COVID crisis, okay, if the Uber shows increase in revenue, you will be asking them question, how come your revenue is high when nobody is driving? Okay, but if it comes to Walmart, if it comes to Aldi, somebody who's into the grocery and retail business, that's a different thing because they are the only one having doing any business. Okay, transportation company, they will be doing business. Cargos, they're still doing some business. So this type of industry, they will be having positive return. Okay, so that is consistent with the market. But if somebody is not doing well, that's a different issue. Okay, so we need to really consider in relation to the industry and in relation to the company's overall performance to see if it is in line, and if there's any unusual spike, that needs to have a clear explanation why that spike is there. Okay, if you're not able to explain it, we should not just say that everything is okay. As an auditor, we need to have a better understanding of the company and the industry. We cannot be blind, Another is accounting and documentary symptoms. Unsupported and unauthorized revenue-related balances and transactions. This I have seen in one of the companies I was working for, and we got a complaint from one of the accountants who left the job, left the country, and then wrote us back about what was happening in his department. So we had very good, and he gave us some evidence also. So we had very good concrete evidence. And we went back and we noticed that this guy was basically, they claimed they lost the document. So they recreated the document and presented it to our auditor as the actual document. Forget about that. These are massive number, and all they had was just the journal entry. There was nothing to support with that. Okay, and the company did not, for whatever reason, take any action against the main culprit. And then this guy came back in the company later on, and he was involved in even much bigger fraud. Okay, this guy absolutely should not be in the company. So this I have seen, and I told you about my friend in waste management. He was doing the same thing. He was forced to enter entries that has no information. Another interesting thing I'll tell you, accountants, they are simple people sometimes. I mean, they are very genuine people. So when you tell them to put an entry, you have a description column, right? In any entry accounting system. This description column, they have to really say something about this transaction, and they have nothing to say about the transaction. You will see some interesting comment there. Basically, they will tell in their own word, this is a fake entry. Okay, so when you do transaction testing, please do pay attention to the description section. Or if you do a general ledger detail, again, look into the description section on the unusual or unexplained transaction, you will see some interesting comment written by the
Can you
accountant.
can you share with me some interesting comment? I would like to hear.
Like they will just tell you there is no support for it. Okay. Or in one case, they basically said, the ticket to Manchester United. I think that was one of the Taksin's company.
Okay. But I mean, the ticket to Manchester United is maybe obvious, but no supporting document. Sometimes I saw that, to be honest, and it's very difficult to justify. And when we discuss with the accountant, they just saying that, oh, because in some country, like I give you example, like in Thailand, we don't have the taxi receipt.
Yeah.
And when they keep putting the taxi receipt, so we don't have supporting. Yeah.
Yeah, that's going to be nominal amount. I'm talking about big amount, millions.
I know, but sometimes imagine when a whole year the taxi can cost like 100,000.
Yeah.
Because it's a whole company.
In a bigger perspective, nowadays, like for example, you have Uber. A lot of companies, they insist that you use the Uber because then you have a receipt. And you can have some companies, they have this Uber business account. So when you use that account, you automatically get charged.
Yes, just for your information, Thailand banned Uber.
Oh, really? Now what, you have Grab now?
Yes, we have Grab, but we don't pay by bank account. We pay cash.
Oh, okay.
And the reason they banned it is a government decision.
I see. But even then, the Grab receipt, if you pay cash, you have that screenshot. Okay.
Yes, correct. Yeah.
You have record.
Unless they forgot to do a screenshot.
Yeah, it will be in the history.
Oh, really?
It will be in the history.
Good.
It is on the history. Okay. It will tell you where you got the car from, where you went, and how much is the amount. It is on every, they maintain, I don't know how long they maintain, a couple of months they maintain. Okay. So I like my Grabs, it will tell me everywhere where I took Grab, in Singapore, in Indonesia, in Malaysia, and it is all recorded there. Okay. So that is there, but on the bigger transaction, it will tell you, because poor guy, he knows he has been pushed to do an account and he has to write something on the description side. What he's going to do? He's going to say no documents provided or something like that. Okay. The ticket to Manchester United, because it is illegal under FCPA to give any kind of benefit to the executives. Okay. So we saw it was during one of the investigation we were doing in Thailand, and that was mentioned there. Okay. That they got the tickets and the plane fare and everything from there.
That's interesting.
And missing documents, photocopies, originals are not there. Okay, they have a photocopy of it. Unusual journal entries. I told you I was one of the investigation, the paper mill. We were able to understand once we saw the amount, the massive amount for Keofin, and then we basically got the explanation that makes sense. I saw the Keofin trunk, I saw the pricing of it, and yeah, that makes sense. That's no longer unusual. But during the first review, it took us in surprise. Okay, but you will see that type of analysis needs to happen. The revenue to ledger, sales, cash receipts, okay, that do not balance. Nowadays with ERP, these are not an issue anymore. There will be more of an other issue, no documents. Control symptoms, there will be control issues. In fact, there is an article from AICPA, a management override of control is Achilles heel of fraud risk or something like that. You can do a search on that. There was a very good discussion on it. How if you see management overriding or approving too many controls, okay, or sometimes you'll see in organization, I have seen especially it is more prevalent it's not that prevalent in America, but outside, especially in Asia and Middle East, it's more prevalent. What the department will do, they will go straight to the CEO. They will bypass. At the last minute, they will come. Then they say, oh, I need all these approval. I don't have time to go through the whole process. they will take it straight to the owner or the CEO. And the CEO will sign off on it. Now, what they have done, they have basically bypassed all the controls that we have put in, an organization have put in to make sure that every transaction goes through the vetting process. In one of the company I was working on, when we went in, we realized that even if I need an extended leave, no matter, even if the janitor needs the extended leave, that needs to be approved by the CEO. Or sometime if we have what is that? If we have penalized somebody, the culture was they will go straight to the owner or the CEO to get override. And slowly we put the controls in that what used to happen, if they go to the CEO, they will push it back to us. We put a control mechanism around it to make sure that that doesn't happen. So management override of the CEO is a massive problem with any kind of fraud, and especially in the revenue, managing the revenue cycle. New, unusual, or large customers that appear not to have gone through the customer approval process. Again, I'll tell you, in the vendor onboarding process or customer onboarding process, especially in the banking sector, KYC, they will go straight to the top to get an approval, or top will send you an instruction, okay, forget about every procedure, accept him as a customer. So these are the risk areas that you have. These are symptoms that something else, something wrong is happening. Weakness of the cutoff process or other key accounting process. These are control issues. These are critical controls. When you see it is not followed, or it is not in place, or it has been bypassed, that should be a red flag for internal auditor or external auditor. Again, external auditor, I think they sometimes don't spend enough time on the internal audit. Internal audit reports, even sometimes they don't tell you the truth, they tell you it as is, but they mention it in so many words, the same thing. So if the external auditor pay attention, they can capture material issues. Behavioral and verbal symptoms. Okay, that is, suddenly you'll see a person which is very nice and gentleman, suddenly his behavior will be very, very disturbing. He will lose temper, he will shout at people, curse at people, and this type of behavioral symptom will rise. You will be wondering, like, why this guy suddenly is reacting that way. Okay, or they have documents, when they will leave the office, they will lock the door, they will never go on vacation. Okay, especially in the banking sector, they don't have it anymore. I hope they don't do it anymore. That used to be the case. Some of the big banking fraud relates to people who never took vacation. For 20 years, the one guy in Singapore, Nomura Security, I think, the 20 years he did not take any vacation, and he was involved in one of these financial transaction fraud. So denied access to facilities, employees, records, customer, vendors, or other from whom revenue-related evidence might be sought. Okay, undue time pressure imposed by management to resolve contentious, complex revenue-related issues. Okay, or management will give you a target that is not achievable. They will give you a revenue target that knowing that this is not achievable. So then you know there will be a lot of fake thing going on. We have cases that the management was putting broadband implementation target in such an aggressive way, and that was not achievable. And later on, the audit department found out that some of the areas they said they have achieved the broadband target, that area itself did not exist. Okay, so that's the kind of like fraud coming from the pressure and creates a from the management. Lifestyle symptom. Sometime if you see someone who is like, I had a case where it was a salesperson. His salary was about maybe $1,500, and the watch he was wearing was $20,000. Okay, he was wearing a Mont Blanc watch. His pen was about $1,000 Mont Blanc pen. So when he comes to the interview with me, I mean, all the symptoms were there. We have another case where the salesperson, he came to work wearing driving a Bentley. Bentley rental is about 15,000, about $5,000 per day, and his monthly salary is not even $5,000. Okay, so these are some of the major symptoms. His manager should have raised question about his lifestyle. Major sales of company stock around earnings release or other unusual dates. Okay, significant bonus tied to meeting earnings forecast. Executive's personal net worth tied up in the company stock. So I was telling you, the salesperson, they are going to do some manipulation, but they are not going to be benefit. But it's the executive. Their stock option, they have millions of dollars stock option. In case of, I think it was Barney Eber or Dennis Kozlowski, their salary was not that big, about maybe $1 million or something per month, but their stock options were in hundreds of millions, and they were cashing out on the stock option. They're backdating it. So you have to see what kind of lifestyle they are maintaining. And the tips and the complaints. This is one of the things that you have to pay attention. The hotline. If your company has hotline, the kind of complaints coming through the system should give you a good indication of whether there was any problem happening or not. So tips and complaints that revenue related fraud might be occurring, either from the company whistleblower system or in other way, you have to pay attention. Revenue fraud disclosed at companies with which company does significant amount of business. Sometimes multiple companies are involved in fraud on all the companies involved. Okay, like in case of the Enron, WorldCom, they were doing a lot of telecom customers. So all other companies, Quest, when they later on found out that they were basically each was supporting the other's fraud. Another thing we will talk about, inventory and cost of goods sold fraud. Okay, now here what we're trying to do is give you an idea so how things are impacted. One is on the income statement item, and it will show if anything happens there, if it is going to be affected in the inventory section. Okay, so if it is gross revenue, sales return, sales discount, these are not really impacting income statement. It's a gross revenue, gross sales. When inventory is overstated, then the gross revenue is not, when inventory is overstated, gross revenue is not impacted. Okay. Cost of goods sold calculation, period one overstatement. So these are some calculation lab. If we manipulate one area, how is going to affect the other area? Okay. Most common inventory related fraud scheme. One is double counting, capitalizing inventory, okay, cutoff problem, overestimating inventory, bill and hold, and consigned inventory. Okay, now what happened is double counting is you are counting the same item twice. And I told you that when we did inventory of this housing authority, they have massive items there, you know, rows and rows of refrigerator, cooker, and other utensils, other household items. And we had to climb on top of the boxes to make sure that those boxes are not empty. So you cannot take any risk with that, because sometimes what they will do, they will put a row of actual refrigerator and all the items back are basically empty cartons. Bill and hold sales, we talked about it before, that sometimes the customer will request that we hold the inventory for some time, but in that case, actual liability related to those items should have been transferred. So the auditor, we have to pay attention that those documentation are clean and available. Otherwise, we should not accept it as is. Now, inventory analytical symptoms. What kind of analytical symptoms you're looking into in inventory problem? Reported inventory balance appears too high or increasing too fast. So if your sale is going up, that inventory should be going down. If you see that your sale is going up and inventory is also going up, then there is a problem there. Okay, reported cost of goods sold balance that appears too low are decreasing at too fast. Reported purchase returns that appears too high or are increasing too rapidly. Now, nobody can say what is that too or fast. Is it 5%, 2%? You have to look into it in perspective to the company's own operation and also the industry performance. When combined, then you will decide what is too fast, too low, too little. Reported purchase discount that appears too high or are increasing too rapidly. Reported purchases that appears too low for sales or inventory levels. Capitalized inventory that looks as if it should be expensed. Okay, so you need to look into these items to protect, to cover the risk of fraud. Like I told you, if you cover revenue and inventory, more or less, you have taken care of the highest risk around the financial statement fraud, because these are the most common area they will manipulate. Other areas are not that easy because revenue is related to stock price. When revenue goes up, performance looks okay. The company's performance, revenue has gone up, sale has gone up 5% compared to last year. Immediately, the industry investors will react by pushing your stock price up, and that's exactly what the management wants, because that's where the bonuses are tied up. Okay, so if you cover these two areas, the most common factors are gone. The other items that is going to come, we'll discuss it tomorrow, a little bit more difficult to manipulate with. Accounting or documentary symptom. Now, we have the 6 symptoms we talked about will apply to every line item in the financial statement. So we talked about the one with the revenue. Now we're talking about the same thing with inventory. The accounting and documentary symptom. Inventory of cost of goods sold transactions that are not recorded in a complete or timely manner. Improperly recorded as to amount, accounting period, classification, or entity. Unsupported or unauthorized inventory or cost of goods sold related transaction. End of period inventory of cost of goods sold adjustment that significantly changes the entire financial result. Remember I told you about the adjusting entries? Be very, very mindful of the adjusting entries. Especially nowadays with the days of ERP, everything should be, most of the transactions should be automated. So a few transactions that is done manually, please look into it. Adjusting entries, look into it. Okay, there are too many adjusting entries on the inventory, maybe you want to look into it. Of course, inventory valuation is also another area that usually auditor needs to be present there. Missing documents related to inventory and or cost of goods sold. If documents are missing for significant transaction, you need to pay attention. Control symptoms. Again, if you see the management override over the control, that's a telltale sign that something is not right. New or unusual vendors that appears not to have gone through the regular vendor approval process. The weakness in the inventory accounting process. Okay, that's why usually in the financial statement audit, most company auditors will make sure the inventory, during the inventory counting process, they are present. But for a multinational company with bigger operation, this becomes a much more critical issue. Okay. Behavioral verbal symptoms, as we talked about, the inconsistent, vague, implausible response from the management. So you have send them inquiries, they are not giving any specific answer. They were like much more high, much more vague answer. Employees arising from employees arising from inventory purchase or cost of goods sold related inquiries or analytical procedure. Undue time pressure imposed by management to resolve contentious or complex inventory or cost of goods sold related issue. I'll tell you an interesting story about inventory also. One time I was in auditing this telco and their marketing department. And when we looked into the responsibility of the head of the marketing, we saw that there was an item there, $80 million worth of inventory sitting in the warehouse. We were wondering what $80 million inventory doing in the warehouse. Okay, what is this about? It's a significant amount for any company. So I sent my audit manager at the warehouse, and he came back. He was laughing. Well, Sharif, I've never seen anything funnier like this. What is this? They have crates and crates of printed material that is about 5 to 6 years old. These are of no use. Those products are no longer in place. God knows who decided to print $80 million worth of marketing material, and it is at in the warehouse, and the warehouse even manager is annoyed by it because it's taking up so much space. Now, what was happening was that under the inventory management policy, if every 6 months one of the item is ordered, then they consider that inventory to be current. They don't write it off. Just to avoid the write-off, what the marketing department, there was one person in the marketing department, his sole job was to order one item from that warehouse every 6 months, so that inventory stays off. Okay, stays on. That's $80 million was worthless. He can't even sell it for the weight of it. Okay, completely worthless. So we basically, one of the recommendations we had was to write off that $80 million worth of inventory. So we need to pay attention to a lot of these small things that can happen from any places, for many reasons it will happen. The management simply was not brave enough to take the action against the person who ordered those items or who was maintaining it. Unusual delay by the entity in providing requested inventory or cost of goods sold related information. Again, when you request something and they don't provide it, and then the issue is there. In my case, it was not inventory, it was about treasury. When I was pushing the treasury head for more information, and basically he came forward and said, Sharif, what do you want me to do? I was doing this because management told me to do it. Okay. Another case was $6 million cash was apparently was missing, and we told the accountant that do not try to hide anything, just disclose everything to the auditor. And he was not telling something to the auditor, and then he said, can we talk on the side? And I said, okay. Then I got off the phone and went back to the accountant. I said, what happened? The accountant basically, the CFO told me to do a topside entry to cover for the $6 million gap. Okay, so this type of scenario, sometimes when you really confront the person, he will tell you the truth. Remember, we are doing fraud investigation. So at the end, we will find somebody who is doing it. Lifestyle symptom. Okay. The revenue, like stock sales towards the end of the period, or suddenly they're trying to get rid of their stock or bonus or stock options. Tips and complaints. That's usually a very, very reliable source for multinational companies. If you have the right awareness campaign, right the hotline and the right kind of people in the team, you will see people are more forthcoming with any kind of fraud related information. Now, in analyzing financial statement for inventory fraud, do this thing. Analyze financial balances and relationship within the financial statements. Look for unusual change in inventory and cost of goods sold account balances from period to period. Look for unusual changes in inventory and cost of goods sold relationship from period to period. Compare financial statement amounts or relationship with other information. Compare financial results and trends of the company with those of similar firms in the same industry. Remember I told you about the industry trend that we need to do also. Compare recorded amounts in the financial statement with non-financial statement amount. Now, remember in the Health South, we talked about their revenue was going up, but their number of facilities were going down. That is inconsistent. How you maintain the revenue, increase the revenue when you don't have enough facilities? So those type of non-financial information we need to look into also. I think that's the end of today's session. So I hope it was useful. Tomorrow we'll discuss the remaining part of the segment. Hopefully you will guys join and we'll have a lively discussion. Please do pitch in to share your experience and thoughts. Any question?
No, I'm good. Thank you so much, Sharif.
Welcome. I hope it's benefited, it will give you some perspective that is to all.
Yes, yes, it's very useful.
I have one question. Let me see. Case studies. Okay. Case studies, maybe what I will do, Mr. Himadri, the 1 hour time period we have is difficult to share any case studies, but I will see if I can do another training session just to discuss with case studies. Okay. That just stay tuned to our account information on our website. I will see if I can design a class, just discuss some 1 or 2 case studies. Okay. On financial statement fraud. I have one, but if I do the discussion, we'll try to schedule it sometime later. Thank you very much. Okay then, thank you very much. So hope to see you tomorrow again.